Hello, everyone. This is Rob McDougall from Zhang Financial here with your weekly economic update. Today is Monday, September 9th, 2024. Last week, in terms of economic activity that was released, it did not come out well last week. So started off okay. The first big data point was last Thursday. Initial claims came in a little better than expected. The expectation for the prior week was 230,000. It came in a little under 227. That was good. But the next day, last Friday, was tough. It was tough on the markets. Non-farm payrolls was really the headliner there, and continued weakness. So we saw this a month ago, and it really riled the markets at that point. The non-farm payroll additions came in far below expectations a month ago. And again on Friday, they came in not only below expectations, but in a repetitive pattern. Not only did they miss numbers, but they took numbers down for the prior 2 months. So in terms of non-farm payrolls and concern around that, people are starting to wonder, given what appears to be labor market weakness, if it's going to follow through consumer spending and manufacturing. Maybe. We're not sure at this point. We suspected maybe the non-farm payroll numbers we've seen over the last year to us looked inflated for a number of reasons. We've talked about some of those on the podcast. So we're not really surprised to see lower numbers and also see negative revisions. But the numbers were, for last week, the expectation for the month of August was we had added another 160,000 jobs. It came in below that at 142. But worse than that was revising the other prior 2 months down 86,000. So virtually no growth in terms of jobs adjusted for the revisions for the month of August. So that wasn't great. Unemployment rate actually came in at 4.2%. That's where it was. Average hourly earnings month over month actually was a little bit better. So expectation was for August an increase of 0.3. It came in at a positive 0.4. So that's a good data point. Average hourly earnings came in on a year-over-year basis, up 3.8%, which is slightly better than the expected 3.7%. So bottom line, market reacted, and we'll see the numbers in a moment. The market reacted very poorly, the equity markets, to the jobs number, and increasing concern over what is happening with the U.S. economy in terms of deceleration. Now, that's the bad. Here's to maybe counterbalance it, but we look at this virtually every week. The Atlanta Federal Reserve, what their expectations are for third quarter GDP growth. Now we're coming off a very strong second quarter that was revised up. The Atlanta Federal Reserve still believes, and they took their expectation down last week, but only to 2.1%. So they're still expecting 2.1% GDP growth here in the third quarter, which would be roughly trend line, maybe a little bit above. Now, a week before, they were at positive 2.5, so they brought it down 40 basis points. But still, if we hit 2.1% GDP growth in the third quarter, I think that would surprise the markets. The markets are kind of freaking out over the employment numbers, and we're not at this point. Another big change last week, so we show you the embedded inflation expectation number, 10-year Treasury minus 10-year tips, and it's 10-year break even. That really sunk last week. So for a good part of the year, we're at 2.2%, 2.3%. Last couple of weeks, it's been coming down. It was 2.3% only 3 weeks ago. Last week, finished the week, 2.03%. So again, the way to read that is the market is expecting an average inflation over the next 10 years of only 2.03%. Fed funds. So we have a Federal Reserve meeting starting the 17th. They'll announce on the 18th a rate decision. A little bit surprising here. I would have expected with the weakness that we saw on Friday, you would see a heightened expectation of 2 cuts. So I'm not sure what happened here, but the expectation for 2 cuts actually decreased week over week. So last week, as we reported, the expectation was a 30% probability we'd get 2 cuts. As of the end of the day Friday, it's 25%. So almost certain we're going to get at least 1 rate cut. Will we get 2? Markets kind of backing off the expectation of getting 2 here on the 18th of September. In terms of the end of the year, that number moved in the direction we kind of would have expected, with what appeared to be labor market weakness and inflation expectations dropping. There's the expectation for 4 cuts by the end of the year is almost complete. 89% probability we'll get 4 rate cuts or 100 basis points by the end of the year. A week ago, that was only 70%. So I've already prefaced the fact that it was a tough week in equities, domestic and international. Conversely, very strong week in the bond market. So we'll go through those numbers. Here in the U.S. last week, S&P 500 down 4.2%, and the leader on a year-to-date basis, or really for the last 18-20 months, large cap growth really got hit. So NASDAQ down significantly last week, down about 5.8%. So within the U.S., growth versus value, so growth was off to a huge lead. That is really reversed. So value has come on very strongly the last couple of months. Last week, value was down less than 3%. Growth in the U.S. down 5.2%. So on a year-to-date basis, S&P 500 up 14.5%. Growth in the U.S., growth stocks up 7.3%. Value stocks now up 12.3%. So that is a really aggressive, very strong rotation in the markets, really just in the last 2 months from growth to value. So the Magnificent Seven, we've talked about it a lot. Earnings expectation for the Magnificent Seven is still high, probably too high, but their year-over-year growth rate decelerates as we go through the year. And conversely, the other 493 S&P 500 components, the expectation for their year-over-year earnings growth increases as we go through the rest of the year. So we've talked to clients individually, talked about it on the podcast a little bit. Because of those dynamics, we did expect some rotation away from growth and into value, and we're seeing it very strongly. So on stocks, non-U.S. international stocks not down as much as the S&P 500, but nonetheless down last week. MSCI World Index, so the developed markets ex-U.S. down about 2.9%. Emerging markets, actually the best performer, down only 2.3%. China down about 2.5% for the week. So horrible week in equities, no doubt about it. Fixed income rallied very strongly. So the 2-year yield last week down 27 basis points. The 10-year yield down 20 basis points. So the Bloomberg U.S. Aggregate Bond Index last week up 1.3%. Now on a year-to-date basis, up 4.4%. So that benefited duration clearly, longer duration bonds. Just last week, the Bloomberg U.S. Long Government Float Adjusted Bond Index was up 3.2%. Well, let's take a look at economic activity coming up this week. So big news coming up starting on Wednesday, Thursday, Friday. But starting on Wednesday, we have CPI, we have CPI core coming out. So the expectation on a month-over-month basis, CPI itself, the headline number, is expected to be up in August 0.2%. It was up 0.2% in July as well. CPI core, same thing, was up 0.2% in July, also expected to be up 0.2% month over month for the month of August. Again, that'll be released on Wednesday. On Thursday, we have PPI and we have core PPI. So PPI month over month is expected to come in just as it was in July, positive 0.1%. And core PPI is expected to come in flat. Last month of July, was up 0.2%. So it kind of looks like a little smoothing there. So those are the inflation numbers. Those will be the key drivers for economic info this week. We also, of course, jobless claims. We keep mentioning this every week now because there is such a focus on the labor markets since the first non-farm payroll disappointment came out a little over 4 weeks ago. Last data point for this week is the Michigan Consumer Sentiment Index. That's coming out on Friday. It came in the month of September at 68, in line, expected to be in line at 67.9. So that's it for our economic wrap-up. We thank you very much for your attendance and hope to see you next week. Thank you.